Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization. He's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and has been a CPA for over 29 years.
Yeah, so it's over 30 now, but thank you.
Okay. And so then I guess you've been an attorney for about 20 years.
Yeah, almost.
And he graduated from University of Michigan with a degree from its business school and from Taft University School of Law in 1996 and has his own law firm. And in a past life, he was a sports writer covering Major League Baseball, National Football League, and other sports. So Scott, thanks for joining me today.
Thanks for having me. Appreciate it.
Today, Scott and I are going to be talking about the sale of a residence. I think that it amazes us because we're people that deal with this sort of stuff all the time, but there's still a lot of confusion related to this. And I think part of it has to do with that a lot of people get their tax advice from their barber or from their hairdresser. Anyway, I also have a little book here, Real Estate Tax Handbook. It's available on Amazon.com. There's a Kindle version there if you like that sort of thing. And also the hard copy edition if you prefer that. So let's get on with this. If I sell a residence and I replace it with another one, does that defer the gain?
It used to, a long time.
long time ago.
A long time ago, yeah, exactly. Yeah, so the old rule is called 1034, and that's a code section of the federal tax code. And that idea was you sell a property for 100, and if you buy another property for 100 or more within 2 years before or after that sale date, then you can avoid the gain. Because like any other asset, it was a capital asset, and if you paid 20 for it and you sold it for 100, you had 80 gain, and that would be taxable income except for this rollover rule. So then in 1997, seismic shift on the whole thing. And by the way, and you mentioned it, I believe, earlier, that for those people, there are some people out there still that have a house that's subject to this old rule, so don't throw your paperwork away. All that jazz about 7 years or 5 years of record retention, no, it's 37 years. It's 57 years.
Yeah, right.
So there are some properties out there whose gain today would be computed with respect to an old transaction that was under this old 1034 rollover rule. But notwithstanding that, in '97 there was a law change. There was a code section 121, which was in those days if you were over 55 and you were not tainted by being married to somebody who had done this before, et cetera, one time in your life you could sell a property and get an exclusion of up to $125,000. So that changed. They dropped the 55 business. They dropped the one time in your life, so now you can do it multiple times, subject to generally once every 2 years. The limits were expanded. Married filing jointly, you can avoid, and this is a permanent exclusion of $500,000, or a single person of $250,000. And in fact, recently, I don't know if you've seen this case, but recently one of the courts had ruled that if you have 3 people who own the property, you can actually get $750. They get $250 each. So interesting, how this law works. So it's an exclusion, though. Exclusions are better than deferrals. Deferrals, like a 1031 exchange that we've talked about in the past, those are you solve today's problem, but you really push it in the future. This is a permanent exclusion to the extent of the limits.
Okay. So can you convert a residence to become qualified for a tax-deferred exchange at a later time?
Oh, absolutely. Yeah, absolutely. That if you live in a house and you decide for some reason that you want to enter into a 1031 exchange, then you can change the character of the property. So this would be important for someone whose gain exceeded this exclusion limit. So let me give you an example. A couple in 1965 bought a house in Saratoga, California for $200,000, and today the house is worth $38 million because everybody from Google wants to buy it. Right?
Okay.
So this gain, all kidding aside, this gain exceeds the $500,000, and the original couple are still in there, and so forth. So they can move out, change the property into a rental property, and then we'll talk about how long in a minute. And then upon the sale of that, they could actually trigger what we call boot for the $500,000. So they can cause themselves a gain, which would be exempt, and then the excess gain, let's say that's another $1.5 million. The excess gain could then be rolled over by buying a replacement property not in the residence sense, but in the investment sense. Mm-hmm. So that's certainly a possibility. So that actually is, for anybody watching this in that area with that kind of a fact pattern, they should consider that, because so many times as preparers we get, oh, they sold their property for $4 million, and you look at the basis as $1 million, mm-hmm. and they have a gain of $3 million, and then they want to know how can you can't do anything because it's all closed. So yeah. This would require some planning. Now, as far as if you do that conversion, so the question often is, how long do I have to move out before I sell? Well, on the outside, the 121 rule requires that you own and occupy the property for 2 years ending on the date of sale. So by subtraction, that means you have to sell within 3 years. Mm-hmm. Right? You have this deadline sort of thing, this 3 years. The IRS has said in a lot of rulings back to the 70s that if you hold a property 2 years as an investment property, that in fact will qualify for this, the held for investment required of the 1031. So ideally it's in that year 4 to year 5 period that you sell that property.
Okay. What are the basic guidelines for the sale of a residence?
Well, when you say sale of the residence, so the residence has to be a principal home, and the regulations describe that as being, where you live, where you pay your bills, where you vote, where you go to church, federal tax return, page 1 address. That's in the instructions. If you sell a property and you ending on date of sale, so today is September 22nd, 2015. So I would go back, if I sold and closed escrow today, I'd go back to September 22nd of 2010. And if I occupied the property for at least 730 days, which is 2 years, during that time, not necessarily consecutively, and not necessarily at the date of sale, mm-hmm. and hence the earlier example, and if I owned it for at least 730 days, then I meet the 2 basic requirements to get the exclusion. If I'm single, I can exclude from taxation up to $250,000 of the gain. If I'm married filing jointly, I can exclude up to $500,000.
Okay. What if the residence was acquired in an exchange before and now you converted it to a residence?
Okay. So the 2-year rule of occupying it is still the same. So if I close today, I look back 5 years, and if I've occupied it for 2 out of 5 years, I qualify. There's another rule, there's an exception for the 2-year ownership rule, which is it's found under 121 D10, and that rule says that a former 1031 property, in other words, I live in this now, but it was acquired and it was a former 1031 replacement property, I have to own the thing for at least 5 years. So I would have to have bought it on or before September 22nd of 2010.
Okay. All right. Now here's one of the more recent developments. What if the house was used along the way for a non-residential purpose or for a rental?
Oh man, do we have an hour? Yeah. Well, let me just cite this out. Anybody wants to read the code, and it's a little Byzantine. This is found at Code Section 121B5. B as in Baker 5. Mm-hmm. Interestingly, this is showing how efficient Congress is. When it passed this law, and this law came into effect at the beginning of 2009. The law was passed under the 2007 Tax Act. They actually characterized this law as B4, instead of B5. But we already had a B4, so we had two B4s. So anyway, one of the commentators mentioned it should be B5. So this is what I call the vacation home rule. If you look at the original statute before this rule came into effect, if you had two houses, I always say the examples are New York and Florida. So you have a house in Manhattan and you have a house in Tampa or Miami Beach or something. So what people were doing is they were manipulating their conduct to live in the Florida house when they wanted to sell it. They would live in there at least 2 years leading up to during this 5-year period, and then they were saying, well, I've met my 730-day requirement. So as a revenue enhancer or as a revenue producer, the Congress said, no, this is abusive. These are rich people, and they're always after the rich. Nobody has sympathy for rich people. And so let's make sure that if you have certain periods of what they call non-qualified use, which is either it's rented out to others or it's simply a second home, it's not your principal home, that time frame is considered non-use, and then there's a fraction in the code, and basically the gain that you have is allocated to either qualifying or non-qualifying gain. And so it ends up, and it's really complicated, and it's hard to work on TV without a flow chart.
Right.
But basically you end up with a taxable event, even though you think you might have had a tax-free event. The takeaway on this is, notwithstanding all the mechanics of the law, the takeaway is it used to be, as tax advisors, we could safely say to our clients, well, if you've occupied and owned for 2 out of the last 5 years, you're safe, except for that 1031 rule. Now you cannot do that. You have to ask the question, has the property ever been not your principal residence during that 5-year period or during any time after 2009? And if the answer is yes, then you have to drill down and ask a bunch of questions and work that out. And sometimes it's a gotcha, sometimes it doesn't hurt you.
Yeah. So there's a couple of things related to this. First of all, you mentioned 2009, so it was a new rule, and so if the use before 2009 was deemed to be qualified use, as I understand it.
Correct.
The other is that the use after you move out, when you're in the process of selling, it doesn't count.
That's correct. That's correct.
Yeah.
So a quick fact pattern would be 2009, let's say it was a rental property at that time for 1 year. Then you moved into it for 3 years, so that takes you to the end of 14 or 13, let's say. And then you moved out and you sold it today. So the time from when you moved out in 2013 or 2014 to when you move today, that's not considered non-qualified. So it's only that first year of rental, and then that goes into a fraction, and there's a formula in the code that you have to work out.
Yeah. So it's a lot more complicated than it used to be.
Correct.
All right, what if you had a property and it was a rental property, or there's maybe you have a home office, so you've got some accumulated depreciation here. Then what happens?
Right, so there's a couple things. One is sometimes you do have a residence that used to be a rental property. So let's say you had a rental activity in that property from 02 to 07 or something, and you took depreciation and so forth, and that's accumulated, and that sort of sits on the sideline. You got deductions for that. And then you move into it as a residence, and then you sell it this year, and you otherwise qualify for the $500,000 exclusion. The depreciation that you claimed earlier is said to be recaptured. It's taken into income in the year of sale, and the exclusion rule does not count to offset that. So that'll be actually taxable income in the year of the sale. The similar concept is office and residence, or sometimes people have they have roommates, some business use, or maybe there's an Amway person who uses the garage for storage or those types of things.
Yeah.
So any of that depreciation that's claimed, office and residence or storage or those types of things, that's again subject to the depreciation recapture.
Right, and that's subject to a higher tax rate as well.
That's correct. Generally it's 25%.
Right. Okay. What if you have to sell the home because of an unforeseen circumstance?
Right, so the rule is that to get the exclusion, you have to occupy and own for 2 years. The code and the Congress figured there was going to be some exceptions to this, and they wanted to give somebody a benefit of this rule, even though they might be sort of forced to sell. And that if you are forced to sell because of a change of employment, or because of some health reason, or because there are unforeseen circumstances which are specified in the regulations, this is not something you make up. You look it up, you don't make it up. It's got to be specified in the regulations. If you sell for one of those reasons, the 2-year rule is relaxed, and it works something like this. Say that I bought a property on 1/1/12, and I lived in it for 18 months, and I was in San Jose, and then I got transferred to Phoenix, and I sold the property. And I'm a single person, and I've got $250,000 exclusion potential. My exclusion will apply, but because I only reached 3/4 of the 2 years, I get 3/4. I get $187,500 for the exclusion, which I can apply against the gain. And if my gain's less than that, it's tax-free.
Right. Okay, well, I think we talked about this briefly before, but maybe I'll just highlight it again, because people think, again, that they don't have to worry about these things. And that is, what if you bought the residence before August 6th of 1997?
Right, that's the August 5th is the effective date. In fact, it goes back to, I think the law was enacted May 5th, or there was a transition period.
Mm-hmm.
So let's go back, and I know you've heard these war stories too, and it's kind of funny. So somebody comes in and they say, "Oh, I'm selling my residence," and you say, "Oh, okay, that's really great." And it's a relatively new client, and or we don't, as preparers, don't really keep basis records for residential property. We do for rental properties, but not really for. Oh, so when did you buy it? Oh, 2002. And then the next question is, I bought it in 1996. Oh, did you sell another property to buy into that? Oh, yeah, there was something, and this was a form called 2119, which doesn't exist anymore. Yeah, I remember. So we have the San Jose house, but we used to live in Milpitas, and we sold that property and bought into that. But before then, we lived in Fremont. And before then, we lived in Oakland. And before then, we lived in Kansas City. And it's possible that there could be a string of these deferrals. And so you paid $200,000 in 1996 for the property you're selling. That's not the basis. Mm-hmm. That's not the base measurement for the gain. It goes all the way back. As a result, the tax code intends really for us to start throwing paper away. That was one of the aspirations of this rule. But that person has to have the escrow papers going all the way back to the original home and bought in 1941 in Kansas City, which is kind of amazing when you think about it.
Good luck with that.
Yeah.
So maybe we should talk about that for just a moment, though. It's not really on here, but what about record keeping related to a residence?
Basis is what you paid for it generally. And then capital improvements. So repairs, that don't really count. You call the plumber, the thing is stopped up, and they come and they fix it, or that's a repair. That's a personal expense, not deductible, and it doesn't get counted for the basis. So then you look at really what's a betterment: new roof, a room addition, a swimming pool, perhaps a sauna, perhaps a new brick patio. Those types of things that are relatively permanent in nature. And I don't think anybody really is well situated to say definitively, oh, if you do this, then it's definitely this. There's case law on both sides of the question as to whether an expenditure is a capital improvement or a repair, and the general proviso is facts and circumstances. What was the nature of the beast? Okay, so if you have a capital expenditure, then you should be able to supply a canceled check and an invoice or some sort of a receipt from the either the supplier of the materials or the contractor or both, whatever the case may be.
Yeah. So, practically speaking, some of this may seem impossible, but what it means, though, is that when you're going through the process, and I go through. I'm an accountant. So, a pretty extensive thing of going through my bills for the previous year, each year, and also the process of trying to throw out as much as I can, from 5 or 6 years ago. And so anyway, so you really need to think about, should you be keeping some of these things in a binder? One of the problems that we have nowadays is most of us don't get canceled checks.
Right.
And so so there is a real key document that's a real problem. And you can usually only go back, if you're lucky, maybe 2 or 3 years, and for the bank to provide you with some of these things, if you even know what to look for.
Well, and the other issue is people pay by e-pay.
Yeah.
And so the check,
PayPal.
the check is paid. For the bank issues the check, and you don't physically touch a check. You punch a button on the computer.
So there may not even be a check. Yeah. So anyway, now the IRS has said that it will accept, like, if there's a list that's on the bank statement. But again, most of us throw away our bank statements after 5, 6 years, if we're lucky with that.
One of the
I've known people who throw them away every month, by the way.
One of the things that the new technology is helping us is this scanning. So if you have scanners are cheap, but don't leave it on your hard drive, because that'll crash and go away too. So scan everything. It'll be the theory anyway.
Put it on the cloud or something.
Put it on the cloud correctly.
Yeah. So anyway, folks, this is a big process. For a lot of people, it's not so critical because 500,000 still is sizable, but 500,000 in 1997 is probably like $1.5 million now. Well, and there's been no inflation adjustment
in places like Manhattan, or a lot of places in California, that was almost inadequate right off the bat. And in places, in many areas of Ohio, for example, they're not even getting close to 500,000 in terms of a price, not to mention the basis. So that was sort of the aspiration. This was affected, 47 of the states positively, and then there's us, of course. California is the outlier.
Yeah. Let's see here. So again, what is a principal residence?
So principal residence is defined in a regulation under Section 121. It's where your main home is, where you live. There's a publication, I don't know what the publication is, but it describes all these things. Mm-hmm. The regs talk about where do you vote, where do you go to church or synagogue, what's the address on your Form 1040 on page 1, where do you bank, where do you work, those types of things. I'll tell you where the audit is. I mean, if people come in all the time, oh yeah, I live in Tahoe. You don't live in Tahoe. The audit tool that's used now often is they'll look at your Visa bill, your MasterCard, Visa, Amex, and they'll see where you spend your money. Where do you go to the grocery store? Because we pay with credit card for the groceries now. And so they're seeing all these entries, Milpitas. No, I live in Truckee.
Yeah.
No, you don't. You live in Milpitas. So you're down at the grocery store every 4 days buying, groceries.
I think there was a case quite recently, basically a truck driver. And so this guy was going all over the place, and he claimed a particular place as a residence, and the court says, you don't live in that place. You live in your truck.
Right. Right.
So anyway,
well,
principal residence can be a yacht.
I was going to say, as long as it has kitchen and toilet facilities, it can be a boat. And it could also, what's the other real common example? I guess you could have a cabin or
motor coach.
Yeah, you could have an RV kind of thing. Yeah.
Yeah. So got a toilet and a kitchen in it. Then
which is an interesting thing. Not getting off the track a little bit. If you have a motor coach, as you say, and you have a home, and then you have this motor coach, and it has a note on it, and the note's secured by the motor coach, then you can take an interest deduction on your itemized deductions. So
right. Yeah. It's a residence.
It's a residence.
That's right. So that is a whole other thing. We could do a program just about mortgage interest. Anyway, we just have a couple minutes left. I think what I'd like you to do maybe is to throw out some final thoughts related to this. In the past, I think, like I said, there's been a lot of confusion about this. I'm hoping that our little discussion here will at least clarify it a little bit. And this is probably the one time that many people should go and get their help with their tax return.
Right. So the old rule of if you live in it 2 years and you own it 2 years, this kind of general advice that was just sort of thrown out there. That's really highly suspect now, is you really have to ask these questions about what's been the prior activity in light of this this B5 rule that came in. That's one of the things. The other thing is, and this is really true for a lot of transactions, don't do the transaction and then show up in April to your preparer and say, geez, I did this. Now, I understand the person from whom you're getting advice is charging you nothing for the advice, but that's exactly what it's worth, right? So call the accountant. If you have an accountant, call your accountant and say, I'm thinking about doing this. Is this going to be a problem? It's usually not that big of a deal. It's not that expensive or time consuming, just to get some, litmus test on what you're doing before you show up next year, because next year is too late. You can't undo things. So, and that's true, especially with this principal home thing.
Yeah, I thought it was interesting. I have a friend who's actually an excellent estate attorney. He and his wife sold their home because, no longer his wife. They got divorced, so they sold their home. And suddenly he discovered he didn't know where the statement was from when they bought the house.
Right.
So you need to know where these things are. Keep them in a safe deposit box.
Right. There is a trick. One last nugget. You can look at the transfer tax and then work the tax rate backwards.
That's what they ended up doing.
Right.
Folks, we're really out of time, so I hope that we've brought some things to your attention. Again, if you have a situation where you're thinking of selling a residence, maybe a good time to go and get some tax advice. We see you next time on Financial Insider Weekly.